Okay, good evening, everyone. Thank you for your patience. We did want to wait for everyone to get in. We still have some people still getting in, but I'm going to get started. Again, this is a discussion of the health of your Fairfax County pension. So you, as our members, our retirees, and we'll be speaking tonight. So my name's Jeff Weiler. I'm the executive director. Again, apologize for being late starting, but again, we wanted to make sure everyone had a chance to get in. So tonight we'll be speaking in general about our retirement systems. As you know, we have three different retirement systems: the employees, the police officers, and the uniform system. For the most part, I'll be speaking to them as a whole because for the most part, they are the same. Obviously, the benefits are different in each of the systems, but in terms of how we operate and invest and all that, we're more similar than different. So if you have questions, put them in the chat. We'll get to them as we can. And we are recording this. And if you signed up with your email, you should get the recording of this after this meeting's over. If not, we're going to post it on our website along with the slides so that you can have those for your reference. Again, thanks again for coming tonight and virtually. So a couple things. I'm going to do about kind of a top 10, if you will, talking about what a defined benefit pension is, because that's very important, how your pension is funded, how we are long-term investors, a little bit of a history about our investment returns, talk about how the county has always funded what it is supposed to, which is very important, give you a brief overview from actuarial information. We'll contrast what you have, what we have, and just so you know, I'm a member of the employees retirement system myself, and plan on retiring someday with the benefits that everyone in the employee system has. So I have a vested interest in this as well. Anyhow, I'm going to contrast a little bit between what we have here and what other people have, particularly in the private sector. We'll talk about how we spread around our investments, give you a little overview of a recent test of our investment assumptions, finally end up with a tip of the hat to the board of trustees for each of our three systems, who are the fiduciaries. Finally, some of y'all submitted questions in advance, and I'll address those as we get to them. In the meantime, please post any questions you might have in the chat, and Amy, who's helping me tonight, will make sure that we get to all of those as we have time. So your Fairfax County pension, which whatever system you're in, whether you're employees, police officer, uniform, is a defined benefit pension plan. And this is very huge, really. You may have friends or family or other people you know that are really concerned about their 401k or their defined contribution account or whatever they might have with their employer, particularly over the last month where things have been a bit volatile, as you probably have read, and the markets have been down, but also up. So, and we'll talk a little bit about that later. But unlike them, so unlike somebody who has one of those plans, you have what's highlighted here in yellow, a defined benefit plan. So your benefit is defined, meaning in this case, it's actually defined in county code, and only the county board of supervisors can change that. It's not something we as staff or anyone else can do. So it's defined, and it's regardless of how much money is funding is available in the system. We're not going to run out of money, but if we did, the county's still on the hook to pay your retirement benefits for as long as you live, and if depending upon your spousal situation, if you predecease your spouse, it will go for the life of your beneficiary or spouse. So that's very important. Contrast that with what are called defined contribution counts, and there the contributions are defined, meaning the individual decides what they want to put in. Sometimes a company will match that, whatever, and it's mostly private companies that do these sorts of things. They're the contribution. So whether it comes from the employee or the employer, that's defined. And when that money runs out, if it's $1 million, if it's whatever it is, then there's no longer money. That's when your benefits would stop from that. Now, some of you have a version of this on top of what you have in your actual pension, which is a 457 or T-row price account. So that would be a defined contribution. In that case, when the money runs out, then obviously you have no more benefit there. Fortunately, you have a defined benefit pension that you will draw on regardless of whether the money's there. And so hopefully you understand that. That's one of the most important distinctions we can make. So within each pension plan, each of the three systems, on average, there are three sources of funding. Investment returns are the biggest one at about 55%, but just over a third comes from county contributions. And then finally, a small amount, 11%, comes from contributions made by employees. That percentage is taken out of the paycheck. And just so you know, this 11% is not the percent of pay, it's the percent of the total revenue that comes into the funds. So, actually people contribute, depending upon which system you contribute, between 4 and 8.65%. So anyhow, that's so it's not dependent on just investment returns. There's a key component of it, which is the county's funding. We are long-term investors, and we have that ability. And I give you a couple quotes from Warren Buffett, who's a pretty famous guy who's done quite well with his investments. And he talks about our favorite holding period is forever, meaning over the long haul, as he says, the market generally rewards. Why? Because why do we have that luxury or that ability? Because fortunately, not all what we owe you comes due tomorrow or next week. Actually, what we owe to you, your fellow retirees, and all future retirees will spread out over 50 plus years. So we don't have to have all the money in the bank immediately to do that. So that allows us to invest in a manner that, if we were just worried about month to month or year to year, would be a lot harder to do. And so the other thing this does tends to, over the long periods of time, short-term downturns in the market, whether it be what happened earlier this month or what has happened in other downturns. And I'll show you some charts in here in a little bit that shows some of this. Over long periods of time, investment returns are fairly steady. And we'll talk a little bit about that in a bit. So here are investment returns. This is going back to 1981. If you look, the blue bars are investment returns. And yes, they fluctuate quite a bit. Many years they're up quite a bit. There's a few very key points there where you can see they were down, such as in, the dot-com bubble in the early 2000s, the great financial crisis of 2008, and then the pandemic a few years ago. In pretty much all cases where you see a down year or two, you see some pretty big years from big increases in the following years. Generally, that's how it works. And when I say we're in it for the long run, we can weather some of these down years because there will all generally be pretty significant up years afterwards. Over the last 30 years, if you look at all three systems, they've all earned over 7% a year on average over the last 30 years, which is pretty decent return. Our actuary, for funding purposes, and we'll talk a little bit about that in a minute, they assume 6.75. They assume we're going to earn 6.75% a year. So we've earned well in excess of that over the last 30 years. And again, as everyone says, past performance does not predict what the future will be, but over long periods of time, as you can see, and if you look on the prior chart, there were a lot of ups and downs. There were some down years, and ultimately they washed out over the long run, and returns were solid. The county contributions, as you can see, this is a chart showing for each of the systems, employees, police, and uniformed, the county's contributions as a percentage of total salaries. In other words, what they put in, not what you as an employee paid, but what the county puts in. And it started out pretty low back in the early parts of the chart. Up until about 2000, the plans were up to 100% funded, in some cases more than that. And the county was contributing much less than what they are now. What's happened as those various market downturns have happened, the way the funding for the system works is when investment returns aren't sufficient to make up to when we don't earn 6.75 a year, as the actuary assumes, the county ends up having to make up the difference. And that's why you can see fairly steep increases in the county's contributions. And those rates that you see up there, they're pretty small numbers, but For the employee system, last year the county contributed almost 34% of employee salary. For the police system, it was 61%, and for the uniform system, it was 55%. The police system is slightly higher because any of y'all that aren't in the police department would or didn't retire from police would know that they are not in Social Security. So their benefit multiplier is a little higher to accommodate that, and thus the cost of their plan is a little bit higher. Anyhow, so the county, this pretty much demonstrates what has happened. The county has always contributed what the actuary says. We'll talk about that in a little bit. That is very important. You might have heard of plans in other places in the Midwest. There are several that were in real deep trouble several years ago, significantly underfunded. And in those cases, either their governing body, whether it be the state or their locality, didn't contribute what the actuary recommended, or in some cases back in the early 2000s, there were counties and cities that didn't contribute anything because they said, well, we're fully funded, we don't need to. Fairfax did not do that. Fairfax contributed all throughout the good years and the lean years, and has always contributed what the actuary says they need to contribute. And that's huge. Not all plans can say that. And it's not something I take for granted and for that. So we talk a lot. One of our most important relationships is with our actuary. And we have an actuary. It's a professional firm called Chiron. They're actually based in Tyson's Corner, but they work with public pension plans all over the country. Anyhow, every year they look at a range of data. They look at some things like annual employee salaries, what they went up, retiree cost of living, investment returns, the numbers of employees who retired, inflation, and then they compare it to what the assumptions are for those things. And so they're underlying the funding of these plans are assumptions for all these kind of things. So every year they look at that, compared to assumptions, and then from that they generate what the funded status of each system is, and then also what the amount the county has to contribute. And that's presented to the retirement boards in the early fall every year, and that's what then goes into the county's budget for the next year. And that's called the actuarial valuation. Then every 5 years, they actually perform what's called an actuarial experience study, where they look at those assumptions, and we, along with the retirement boards, just determine which of those assumptions might need to change. For example, if employee salaries are going up more or less than what the assumption is over a period of time, that gets adjusted as well. So it's really a self-correcting system. And it's not just us sitting in a room here deciding what the county should contribute. It's professionals in the business who do this. Our actuarial assumptions are conservative, meaning, and conservative in this case, meaning benefiting the funding of the system in a couple areas in particular. So each of our systems is not fully funded, meaning assets are not equal to liabilities. So there's a shortfall. And that's very typical. Most systems around the country are in that situation. What is different is we amortize or spread that cost out over 15 years. So basically, it's a mortgage in a sense. The average plan, I'm sorry, this is right. It says 15 years. The average peer is 20 years. I need to correct that. And that some of them amortize over 50 years. If we did that, the county's contributions would be less, but we wouldn't get the full funding for a lot longer. So we're very conservative there. The actuary, they smooth investment returns. In other words, they don't just take every year, they average out over 3 years. The less conservative way would be what our peers do it on average about 5 years up to about 10 years. And then the other thing, and people ask about this a lot, mortality tables, not something anybody likes to think about, but it is important to a retirement system. So used to be in the old days, more actuaries would look, there's a table out there that actuaries put together and say, on average, when people are going to, how long they're going to live. Our actuary uses what's called generational mortality, which does a couple things. One, it bases the expected your expected mortality, when you're going to die, based on what year you're born, because as people, as medicine has advanced, people are living longer. They also then assume that those improvements are going to continue into the future. And some people will say, well, because of COVID, did it change? In a very short period of time, the mortality rate did go up a little bit, but the actuaries have not seen it changing for the long run. Again, for a very short period of time, it unfortunately did affect, obviously, people a bit. But in terms of our funding of our system, it doesn't really, they don't see that continuing. It hasn't, thankfully. But anyhow, that's, so we're very conservative there. The county's funding policy is stated in county code. Again, it's not just something we over here as staff decide what we're going to do. And it was revised in 2016 specifically to try to get the plans to full funding by, well, in the mid 2030s, which we're on track to do. And the very important thing, and it's in yellow there, is the Board of Supervisors agreed to not decrease their contributions to the system until they're fully funded. And I don't have a chart for this, but I could show you one that we have from our actuary that shows all of our systems getting to full funding by 2036. And I think that has not changed in the last several years. I mean, we've been on that track for a while, in spite of investment returns going up and down a bit. And another important thing, this is a bit of a busy chart, but I'll try to explain it as simply as possible. When we talk about the funded status of the plan, which is simply the assets, the total money we have, divided by the liabilities, what we owe everyone, all current and future retirees. That's what gives you to, on average, our systems are 73.4% funded as of the end of last year. So that's the funded status. That's really pre-funding, because unlike some other systems, like Social Security, we're not a pay-as-you-go system. So we do have several sources of money coming in. I've already addressed this. Money coming in from the county. We have employees contributing, and we have investment returns. That comes in on the top. Out of the bottom, we pay out benefits and a little bit of administrative expenses for running the systems. But anyhow, so there is money coming in all the time. And yes, there's some coming out the bottom, but we're not a pay-as-you-go system, meaning we have money in the bank that's really pre-funding your retirement. And we certainly want to get to 100% funding, but just because we're not there doesn't mean we're at risk. In fact, the actuaries, as part of their valuation every year, has to do what they call a depletion test, which is to say if we didn't earn anything, any investments, that we have to prove that we could last for at least 40 years, and we can well exceed that. Even if we didn't earn another bit of investment returns, we could last for quite a long time, just on the balance we have, plus the county's contributions and what's coming in from employees. So just as a worst case scenario, it won't come to that. And if it ever did, I'm sure I probably wouldn't be employed anymore. But anyhow, that is where that is. And this is very important too. The system's assets are very well diversified. This is a quote from a guy who very influential in the investment world that created what they call modern portfolio theory. It's what every investor really follows these days. It talks about how diversification is important. In other words, we don't just invest in one stock or even just stocks. We have bonds and other asset types, and I'll show you a chart here in a minute that shows you the kind of things we're invested in. So you spread your money across a number of different asset classes, which means, for example, like stocks and bonds tend to not trend together. If stocks go up, bonds can go down, vice versa. So the idea is they tend to offset each other. And if you have a lot of different asset classes, there are other things like real estate or real assets, which is not just real estate, but also physical assets. They tend to fluctuate differently. So you have different fluctuations that kind of offset each other. That's what diversification does. Or in simple terms, not putting all your eggs in one basket. The three systems have investments with 102 investment management firms, and actually in over 150 different specific funds or investment types. Looking at it a little differently, this shows you for each of the systems, and the colors are different asset classes, everything from things like absolute return, which are things like hedge funds. There's risk parity, which is a small allocation of, there's a little bit in cash and other. There's global equities, which are stocks and bonds, fixed income, which are, global equity is stocks, global fixed income is bonds and other debt instruments. You'll see multi-assets, that can be real estate, or that can be other kinds of things, infrastructure. We have some investments in music managers that do music royalties, rail car leasing, things like that. Very small investments in those kind of things. And then real assets, which are physical assets such as gold, but also real estate, buildings, and other things like that. Then there's private investments, private debt, private stocks or equity, and private real estate. So anyhow, the three systems are invested differently, but they all are pretty well diversified across all those asset classes, as you can see from the code. So we're not dependent on any one specific area that, so that's what diversification is in kind of a picture, and it really helps us a lot. So we don't, we're not dependent on just if one stock goes down, or even if just the whole stock market goes down. We have other asset types that will likely not be going down at the same time or as much. We just this last year had an outside firm come in and do what's called a stress test, and they looked at the asset allocations, basically that prior chart I just showed you, and ran it through several scenarios, economic scenarios, over the kind of projecting out 15 years to see, okay, under certain economic conditions, different ones, what would the funded status be, and also what would the contribution be. This shows you the funded status. In some we get, in one scenario we get to 120% funding on average. In others, most of them we get to 100% funding. Many of them by 2036 in there is under some of these. These are each of different scenarios. And this has been presented to the boards of trustees this year, and we'll continue to do this every 5 years, just to have an outside look at what we're doing and see, how likely are we to, get to full funding. And this would indicate that we are on track to do that. Let me see. Another important thing is governance, and I put in a quote here from somebody there's a trade association that for public pension plans, and Hank Kim is the executive director, and he puts in there, really notes some of the things I probably talked about, that over the last 20 years, public pensions have done really well in spite of the great financial crisis, and the COVID crisis and other things, which at times, this is an aggregate number, wiped out a significant amount of value, but the systems have come back pretty significantly, and that's not just us. And what's important, each of our systems is governed by a board of trustees, a very good group of people combined. They're active employees, retirees, citizens, and then there's some ex officio, like the county finance director as well. Very good group of people. Some of them have been serving for over 20 years, and they're very passionate and very capable of what they do. And they are the fiduciaries for the plan, and they oversee what we do, investing and pretty much everything else we do. And then just this last year, we had an outside consultant come in and do a review of our governance practices, and they determined that we are well governed. They gave us a bunch of things to look at and for improving things, which is good. But overall, they said we were quite well governed by our boards. And anyhow, so that's that. That was all I was prepared to go through. I just kind of breezed through it quickly, but you also gave us I found about 16 questions that you submitted online in advance, and we may have some more now, which is great. So how is the county pension protected? Is it secured? As I think I said before and addressed, basically the county government is really the backstop, if you will. It is because it's written into law that, your benefits are guaranteed. And in the very unlikely event we had no investments or really bad years and we never recovered from them, the county would have to make up the difference. And that's, again, in law. And I think, and just so you know, they've never reduced benefits for active employees. There are 2 times, at least in recent memory, where they have reduced benefits for future employees. Back in 2013, they made some revisions for people that were going to be hired in the future. And then in 2017, they did another study, made some minor changes too. They have never changed the benefits for active employees or retirees. And while I'm not a lawyer, I don't believe legally they could. Anyhow, so that's how it's secured. And as you know, the county has a AAA bond rating. And one of the things that the bond rating agencies look at nowadays is the funding of the pension plans. And they're content with how well the county is funding our plans and how well our systems are funded. But that's an important thing as well. When do we see our COLA and how much? The COLA will be 2.4%, and you will see it in your July benefit payment. And we have something we put out both in an email and also on our website about that. So anyhow, you'll see that in July. There's one question about what's happening in the federal level. Will it wipe out our pension? I don't see how it could. As I said, in the very disaster scenario where we never earned another dollar on investments, the county would still have to back up and pay your benefits. Again, that's a very unlikely thing. And just so you know, through March, all our 3 systems were, the investment returns for this fiscal year were up between 4 and 6%, which was putting us on track to hit our 6.75% target for the year. Early April was not very good, but by the end of the month, things had leveled out. We don't have final numbers for April yet. We will soon. It may be down a little bit, but not as bad as it looked like at the beginning of the month. Obviously, I can't predict, or none of us really can predict what might happen later in the fiscal year or anything like that. And certainly there's a lot of uncertainty out there. And we can't predict at this stage. We are well diversified. Not everything went down in the month of April. As I said, for the most part, when stocks go down, bonds tend to do better. And some of the other asset classes, that's the same. So we'll see how that goes. But I think we're in very good shape at this stage, well diversified. I'm guessing that the tax base in Fairfax County is shrinking due to the large number of federal employees who have been fired. How might that affect the resources? As some of you may know, the county is just about to finalize their budget for next fiscal year, the year that starts July 1st. And I'm not expert on all that, but I do know from watching the presentations that residential real estate, at least through the period, through the end of last calendar year, we're still doing okay. Commercial was a mixed bag. I think overall it was down a little bit. Some areas were up some. I think it's still early to tell, and again, you'll have to watch the county's budget process and their updates probably for more of that. It really, because again, the benefits are guaranteed and the county has in code what they have to contribute every year, it really won't affect the funding of the systems. It'll put strains obviously on the county, and that's not good. And they already had a tough budget year this year. But even in spite of that, they funded what they needed to for our retirement systems. Can I talk about the bond market and any concerns? I'm not sure exactly what you'd want me to talk about there. I don't think we have any concerns at this stage, any more than just the overall economy and what's going on in the and trade and all that kind of stuff. And hopefully that'll get stabilized at some point soon. That would be great, because there's still a lot of uncertainty in the markets right now. But I don't have any particular concerns with the bond market at this stage. How's our fund compared to a fund that tracks specifically the S&P? I don't have those stats readily available. I will say the 2010, well, between 2013 and 2021 were boom times for stocks. And so if we had just invested in stocks for that period of time, we would have done better. In other words, if we just had put all the money in the S&P, that's in retrospect, looking back on it. As I said earlier, we are diversified because we don't believe that we have a crystal ball and can predict when any one specific asset class is going to go up. And really the rise in the stock market for that period was pretty much unprecedented. We're not thinking that's going to continue at that level. But again, yeah, if we'd have been in the S&P from between 2013 and say 2020, we would have been a little bit better off than we were. But again, we don't time the market, and over long periods of time, it doesn't work really. We're not day traders like some people, and you wouldn't want us to be. That's a very risky business to get into. Number 7 is the pension fund managed with any emphasis on socially conscious or green energy investments. Not specifically. We don't really have a position on that. None of the retirement boards have a position on that. It's called out in the world ESG, or environmental, social, and governance. We don't target that as an investment. We have some investments in some green energy. We even have some investments in things that are counter to that, in fact. And sometimes you can make money when markets are going down. So there are managers that will make money even when markets are going down. And we have some managers that have done that in the energy space. But anyhow, no, we don't have a mandate for that, and I don't anticipate we will. Are we self-sustaining? I don't know exactly what that would mean. So I mentioned earlier, probably the easiest way to look at that would be, so we have contributions from the county and employees coming in on the top, filling the bucket, if you will. And then out the bottom, we have the benefit payments we're making to all of you and your colleagues and everything that. What we take in is slightly less than what we pay out, less than 2% difference. So we are what is called cash flow negative. That's pretty low. There are a lot of plans out there that are 8 or 9% cash flow negative. It's a function of a mature plan. We now, I think all 3 of our systems have at least as many retirees as actives. And that's changed over the last 10 years. If you went back 10 years, that wasn't the case. We had like 1.5 employees for every retiree. So it's kind of flipped a little bit. Because of that, we are a bit cash flow negative. But we have investment earnings, and as I mentioned earlier, that's about 55% of what we take in on average. So we more than make up for the little bit of negative cash flow there. Where can I find the information about the pension plans from home? We have a wealth of information on our website, which is www.fairfaxcounty.gov/retirement. So if you know the General County's website, just put a slash and put retirement after that. And we're constantly updating it and trying to improve it. And we have some things in the works that going forward that maybe we even make it better. Amy, who helps out with the website, I'm constantly driving her crazy with new ideas of what we need to do better. And we're trying to make it much better. And we have done a lot, but I think you'll continue to see improvement. But there's a lot of information there, everything from you can see actuarial reports, financial reports. There's even interactive funding model out there that you can look at. And then other things like what's your COLA going to be and things like that. Will there be investment in the cleared Bitcoin ETF? And other digital. Okay, so 2 of our systems, the employees and police systems, have small investments in what's called blockchain technology, which is the underlying technology that underneath cryptocurrencies. It wasn't a specific investment. This goes back 4 years, I guess now. And those investments have done reasonably well. They haven't been finished. They're longer term investments, but to date, they've done well. One of them we've already more than made up our money on, which is good, even though the fund has several more years of life to earn. But they weren't specific investments in actual cryptocurrencies. And we're not in a Bitcoin ETF or anything right now, and I are planning to. Given the tariff chaos and magnitude of inflation expectations in recent months, plus the measure of residual supply chain, has the board considered using a multi-month average of the inflation rate versus the March rate? So this must have to do with the cost of living, your COLA. No, we haven't considered that. And again, the COLA is defined. How we have to calculate it and all is defined in code for what it's worth. It's not just something we dream up every year to do. It is based on the change in the index for the cost of living index, the CPI, for the Washington area from March of the last year to the March of this year. And because that's an index, that index keeps going up. So every month it changes by whatever that inflation is that month. It's a little hard to understand that. But say if you started with $1, and that's sort of how they look at it, 10 years ago, every year, if you get a 2%, it gets added to that, and then you get 3, that 3 gets added to that. It does, and month to month, it might go up and down a little bit, but in the end, you're really getting the same thing as if you did an average like that, is what I'm trying to get to. I'm probably not explaining it terribly well, but I do hear your concern. And there's some systems like VRS, they do their COLA at the end of, based on the December 30th. In some years, theirs has been higher, some it's lower. Over the same period of time, it's going to be the same pretty much, but it's just a matter of which month you get it. So, and ours is in code that it's as of March. How much county subsidy for health employees? So the max is 230, right, Amy? I said somebody asked this the other day. Yeah,
that's correct. 230.
Yeah, 230 is the max, and it's a graduated scale based on the years of service. And we talked with a group the other day about this. We don't fund that. That comes out of the county's budget. It's not even something under our control here. It's actually done under Human Resources. It was increased, I think in 2017 was the last time, not by a lot. We know and we hear all the time it's not sufficient to meet what the cost of healthcare is in retirement. But as far as it's not something I can do anything about. I guess you'd have to lobby really the Board of Supervisors of the county in general about that. But to be fair, I guess, to look at a bigger picture, the pension that we all have here in Fairfax is very good compared to a lot of places. The subsidy or the healthcare costs not as good, and I certainly grant that. But it's like anything, the money would have to come from somewhere, and they're already having to put a significant amount of money, excuse me, into our retirement systems. How likely are we to keep getting COLAs? As long as the CPI goes up, as long as there's inflation, you'll get them. There are no negative COLAs. There is a system or two out there in other parts of the country that actually they have negative COLAs, which we would never been proposed. It's not in the code. So it's defined. Now, and it can go up to 4%. Pretty much automatically. It's just whatever the CPI is, but there is a max of 4%. And when there's an ability for the boards of trustees to grant an additional 1%, but that's tied to the system being fully funded. So when we get back to 100% funding, the boards of trustees could, if the CPI went up by more than 4%, could grant up to 1% additional. But I don't think I think you'll get it. I mean, I don't see any move to changing it. Again, we can't change that. We can't eliminate it. Only the county board of supervisors can, because it's hardwired in the code. I already talked about Bitcoin and blockchain. We have a little bit. It's about 1.5% at cost, basically, of the employees and police. Uniform does not have any. Do we hold commercial mortgages? Not mortgages directly. We have some investments with managers who buy pools of them. They tend to be groups of mortgages, collateralized, CDMAs, whatever. There's a term for it. But anyhow, they're kind of like a group of not individual mortgages. And, the concern there would be, I think the commercial real estate market is not doing great in some categories. Office space is not doing so well. Malls had not been doing well, but they're actually seeing some improvements in mall. Data centers have been great for those places that have them in terms of assessed value and value in general. And like medicals have been a growth area. So not all of commercial real estate has been down. And we've had some managers in that area that are what called opportunistic, which have been able to, for example, after the great financial crisis, we have a couple managers that were able to pick up mortgages, both residential and commercial mortgage securities, at significantly less than full value, maybe 35% of, they were able to get into it. And then ultimately they were able to stay invested until they got back to 100%, which made a very good return. So, there's money to be made in pretty much any market, even down market sometimes. But we have some, but not a huge part of the portfolio. And last, is the payment of pensions impacted by the renouncing of American citizenship for retired employees now living abroad? I don't think so. Again, I'm not an attorney, and there's so many things going on in that area in terms of people being sent out of the country that I can't guarantee. Who knows what's going to happen? I seriously doubt. As long as you're a U.S. citizen, I can't imagine that would change. But it is an interesting question. I wish I could say no, it'll never happen, but these days it's hard to make those kind of assertions. That's all the prepared questions. So what else do we have?
Jeff, there was one question at the beginning, and someone asked if this was the first meeting on this topic.
We did one last year. It's different. And we did one also more deep dive on our investments as well. And we could do another one of those. We can do any of these again, if there's interest in it. And in fact, we could put in there, let me just a second. I put up their survey. I don't know if you can see that. Hopefully you can.
I can, yes.
So a couple questions in there. How did we do tonight? If you want to click on that, did we do bad, great, whatever? Be real. It's so, and then there's one on too much information, not enough. And then we have one in there about what other topics would you like to learn? How we invest, what the actuary does, how the COLA works, board of trustees, the staff who serve you. If you want to know about, we have a great team of people here. I'm blessed to have working with me that really do all the work and do great things. But anyhow, please, if you want, tell us that. Any other questions we have in chat?
There was one person who expressed frustration that we didn't start on time, but someone else, and you also explained that we were waiting for others to join the meeting. So I think that got covered all right. There was another question about the COLA. If I understand you correctly, if the COLA was to exceed 4%, the retirement funds have to be fully funded.
Yes, that is true.
That's only to receive that extra 1% option from the board of trustees.
Right.
But if it exceeds 4%, you'll still receive the 4% COLA, the maximum amount of 4%.
Okay. And I'm seeing the polls not showing up. I apologize. We're on a bit of a new platform here and meeting Teams, and we're still learning a little bit. It's supposed to show up, but I guess it may not be. But I apologize for that. Feel free though to send in something. We have a couple ways you can give us feedback. There's one called it's retirementquestions@fairfaxcounty.gov. It's one email address. You can send an email to me. You can find my email out there. It's on our website, but it's Jeffrey, Jeffrey .weiler@fairfaxcounty.gov. I'll even put it out there in the.
There was another question about whether the recordings from the previous meetings, whether they're online, and they are not recorded they're not published on our website.
We did share them a while back, but they would have, they would have been a while back. And to be honest, some of them were a little bit, things change a little bit over time, and some of the numbers would have been different anyhow if particularly we're talking about funding. But so I just put my email address out there in the chat if you have a question or concern or anything, and you can't find anybody else. And also use retirement questions at fairfaxcounty.gov. We watch that every day and try to get back to everyone as soon as possible. And again, I apologize that the survey's not showing up. But
there was another comment. It said that it has to do with the fully funding with the additional 1%. It says the funds are projected to be fully funded by 2036 to 2039, so the additional 1% is highly unlikely. I've calculated some of those numbers for the COLAs, and I teach some of the classes. The average over the last 30 years or so has been about 2.5%, and there's only been a handful of years when it was 4%. In excess of the limit, and the retirees were limited to the 4%. So
yeah, that's a good point because excuse me, and I apologize that I've been choking up here. For you to get whatever the COLA is, it is really tied to the CPI. So if the CPI only goes up, well, like it did this year, 2.4%, that's all you get. So to get more than 4% means the consumer price index would have to go up more than 4%. Which you did a couple years ago, and we had to cap it at 4%. That was 3 years ago, as it's on the chart somewhere. But anyhow, so that's and there's a lot of questions about the consumer price index is what pretty much everyone uses. Some people could argue it's not exactly relevant for retirees because it's a market it's based on what they call a market basket of typical things people buy, and people can make the case that what's typical for a younger person may not be typical for somebody that's later in life, and that certainly could be valid, but we have not found a retiree specific index that we can look at or use. So maybe one will come up at some point. I don't know that it would vary a lot, but it'd be interesting to see.
Jeff, there's a couple more questions. There's a comment. It would be helpful to have a meeting like this each quarter, given the political climate we're in. And so I'm sure we will look into that. But if you want to send your suggestions on what that meeting would like to cover, that would be great. There was another question about whether this recording will be available later and whether the slides will be emailed to us.
Or you should get a transcript and the recording. Any of you that's signed up by email. That's how it's supposed to work. And again, this is the first time we've run one with a large group like this, so hopefully that works. If not, we'll post the recording or link to the recording on our website, as well as a PDF of the slides. And we'll do that regardless. And if nothing else, go to our website and we'll have it off of the retiree page on the website. And yeah, as far as doing it quarterly, we can do that. And it's not that big a deal for us to do this sort of thing. And if it's something people want, we had pretty good turnout tonight. And I mean, real good. Any turnout's good. And that's fine. So if you want that, I'm glad to do it. And if you have suggestions on what you want to hear about, please let me know. It's very easy to do these things.
Jeff, will you comment on, think about making transactions less paper-based and more online options like changing your withholding or direct deposit amounts?
Yeah, it's in the works. We have to upgrade our pension system that we use, which we have been planning to do for a while. It's a fairly big, that's a very big undertaking. It's costly for one, and it'll take several years. And the one thing we don't want to jeopardize is the number one thing we do, which is to make sure you get your retirement benefit check every month on time and accurately. And our current system does really good at that. So we don't want to jeopardize that. So it's just taken us a while, and it'll take several years to get that implemented. But we know people want that. Our current system doesn't really allow that, so we're going to have to upgrade it, and it's just have to bear with us. And again, we also want to make sure it's secure, as you can imagine, and I'm sure you appreciate that it's got to be very secure, so no bad actors can come in and do something they're not supposed to do or try to steal your information. And so whatever we do, we will make sure it is solid and secure, because the last thing we ever want is for anybody's information to be compromised. It hasn't happened here, thankfully for us, but it could happen, and I worry about that, but we'll still get you that as soon as we can.
And Jeff, aside from people thanking you and making positive comments, there were not any other questions that I saw.
Okay. Well, thank you all, and stay tuned. We'll keep doing these as long as you keep showing up. So thank you very much.